Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we'll discuss employee stock ownership plans or ESOP plans as an alternative to selling your business with Melissa Beezhack. She's an ESOP valuation expert in Pittsburgh, Pennsylvania. Welcome, Melissa. How are you?
Great. Thanks for having me.
Awesome. So, Melissa, let's talk a little bit about ESOPs. Can you provide some basics regarding ESOPs as you would explain it to maybe a business owner?
Absolutely. The way we talk to business owners about ESOPs is, essentially it's an exit plan. When you're thinking about, leaving your business, trying to monetize your interest in a closely held business, one of the options that should be considered is an employee stock ownership plan. An employee stock ownership plan is a qualified retirement plan, but it's an effective way to move to monetize your interest in a closely held business if you have, or if you so are inclined to pass the business on essentially to your employees. There are certain tax incentives and advantages to doing that. Tax advantages to the company itself, to the equity holder as well. And those are things that we can certainly dive into a little bit more. But, the way that I introduce ESOPs is typically in an exit planning situation where a business owner does not really have an idea about how they want to exit. They know they want to exit, but they want to consider, okay, what are my options to exit? And, after you have some meaningful conversations with the business owner, you can quickly tell if the owner and the business itself is right for an employee stock ownership plan.
Well, and I think that it's interesting because when business owners go to contemplate an exit strategy, right? They think, okay, I can go sell my company outright. I can go to market, so I can go try to find some outside buyers. Sometimes they might have family members that could take over the business. But what we're talking about here is really if some of those options, you might not have family in the business, but you have employees that have really been part of that business for a long time. And so then we get into with business owners, okay, what are some of the reasons to consider an ESOP plan? Because it really is something that you can't take lightly, right? So there are some tax benefits to ESOPs, but there might be some other reasons to consider it. Maybe we can talk through some of those things.
Sure. Start off with the tax benefits because I feel like that's one of the most important components to an employee stock ownership plan. So if you're the selling shareholder, if you're a regular C corporation and you're selling at least 30% of the business to this employee stock ownership plan, you actually have the ability to defer, and in most cases permanently defer the gain on the sale of your business interest. And the way that that's accomplished is if those proceeds from the sale of your business are invested in what's called qualified 1042 property under the Internal Revenue Code, which is basically qualified other qualified investments, you can permanently defer that. That's a big thing. That's a big add for a privately held business owner when they're looking to liquidate. Potentially, they may have, especially in a C corporation situation, when you buy your stock for $500 and then you're selling it for, $5 million. There's a pretty big gain there that you're looking to shield from that tax. So the tax benefits to an exiting shareholder are pretty advantageous. Very different though if you're an S corporation. There's no 1042 preferential treatment for that. But when you look to the company actually has benefits as well. If it's a leverage situation, and when I'm talking about leverage, if there is debt associated with buying out the selling shareholder or shareholder group, there can be debt that is taken on. Essentially, the company, we call them sponsor company, the company is going to ultimately pay for the debt, but the debt is going to be held over at the ESOP trust. Because it's essentially the ESOP is going to be the entity that purchases the stock from the exiting shareholders. But that any payment within certain limitations that is going over from the company to the ESOP trust in the form of retirement contributions is fully deductible, even when that retirement contribution is being used to pay the debt associated with buying out the selling shareholder. And the big advantage here is that debt is principal and interest. Not only is interest deductible, but the principal can be deductible as well. There are certain limitations that are associated with qualified compensation, but typically those payments are fully deductible. The other thing is, if you make dividend distributions, any type of distribution that's going to the ESOP does not pay tax. So those dividends go over tax-free. One thing that we see very often is once the corporation pays the debt, or once the debt is paid down on the leveraged transaction, you convert to an S corporation. Why? Because at that point, you can make distributions to the ESOP completely tax-free. There's no one at that point is paying tax because the ESOP is a non-paying entity, a non-paying tax entity. So you're saving right off the bat, depending on where you're domiciled. In Pennsylvania, federal and state taxes get close to 30%. So at that point, you're shielding 30% of your income from taxes. So we always talk to business owners about using ESOPs as a financing tool for companies. Ideal ESOPs, but we talk about, one size doesn't always fit all in terms of exit planning. ESOPs are you need to be very careful. If your company is in a very cyclical industry and really sees a ton of ups and downs, that's difficult to manage an ESOP because they need to be valued annually. If you see those extreme fluctuations in the stock, you could potentially have situations where employees cash out at a low point, and then in the next year when the stock value rebounds, other employees exit, and then those employees that exited a month or a year before are upset because they feel like, well, I exited at a low value. There could be a problem here. You want to make sure that when you're looking to install an ESOP, that the company has a qualified employee base. So when I say qualified employee base, I'm talking about you don't want to have an aged workforce because you don't want to have a situation where you install an ESOP and then you all of a sudden have a repurchase obligation as soon as some people vest. So you want to make sure that you have a strong workforce, but then a workforce is kind of mixed in terms of age ranges. You don't want to have an aging workforce because that certainly creates an issue for the ESOP. Sometimes it's very hard to institute an ESOP in a tech company that potentially has IP that could be rendered obsolete very quickly. That also creates a situation of sustainability of an ESOP. So, want to make sure that the ESOP has adequate cash flow in order to pay the debt if it's a leverage situation. You always want to make sure that there's sufficient cash flow for that, as well as a future repurchase obligation. And we can talk about that because I think that that's always one of the biggest concerns of a business owner that's looking to an ESOP. They're always asking me, what's this I hear about repurchase obligation that could really put us under. And repurchase obligation is real because an employee stock ownership plan is a qualified retirement plan. So upon certain triggering events, the employees can place their shares back to the company, the sponsor company, and then the company is required to buy out their shares. In addition to, retirement, death, disability, if you have an employee stock ownership plan at age 55 with 10 years of service, you can actually place about 25% of your interest in the ESOP back to the company for diversification purposes. So that that obligation is real, because if those funds aren't readily available or set aside, it creates a huge issue for the company in terms of cash flow.
Well, and I think it's interesting if we step back just a little bit, because all of those are actually huge benefits for a company to decide to do an ESOP as really a retirement planning tool. But let's step back just one thing, because I think what business owners don't understand is if their company really is even a good candidate for a program like this. So maybe we can talk about things that would make somebody a good candidate, or are there things that just ESOP would never work for them? Things like that.
Sure. There are places like the NCEO, the National Center for Employee Ownership. They do a great job on their website publishing the types of information, basic information on ESOPs that business owners should be aware of. And they go down through, the typical profile. A couple of things that I was just talking about, definitely you want to consider. You want to, if you're in a business that is way too cyclical, like I said, that can create issues for the ESOP. If you already have liquidity issues, if you're already debt laden, you're not going to really pass feasibility if you need to borrow the funds. And for a company like that, it probably would need to borrow the funds to install an ESOP and buy out the selling shareholders. You want to make sure, as I said before, the employee census. You want to take a look at all of your employees that would be eligible to participate in the employee stock ownership plan. And you want to make sure that, you don't have a significant portion of your employee base that, is nearing retirement and could trigger that a little too early on. You want to make sure that you can get through paying that debt before you have to, start thinking about, paying repurchase obligation liabilities. And most, plans are designed to, prevent people from vesting until the debt is paid off. But, handling that repurchase obligation is extremely, extremely important. You can't really take a very small business that is dependent on the business owner and transfer that into an ESOP, because, an ESOP, you want to have good mid-level management, because eventually you are transitioning that business over to your employees. But, one of the benefits of an ESOP is, even if I'm 100% owner of a business and I sell all of it to an ESOP, I can stay around and, ensure that business is going to succeed, groom mid-level management, things like that. But if you don't have a good mid-level management already, you may not be the best candidate. You may be able to take a couple years to get your company in good financial and then internal shape for that, because it can pronounce itself to become issues later on. The other thing that's extremely, extremely important is you have to really understand and embrace the culture of employee ownership. Because one of the things that we see is, business owners that are, really the control freaks, the ones that are involved in everything and, want to have all of this control. Typically, they don't make very good ESOP-owned companies, because, you need to, you really need to foster that environment that is conducive for employee ownership.
Well, and I've seen ESOPs in small companies.
Mm-hmm.
I've seen them in large companies. So it doesn't, size may not be a huge issue, but I've seen some ESOPs in construction where you have a lot of people on the ground and maybe they're great, and you have a leader. And I've seen, what other industries have you seen a lot of movement towards ESOPs? Are there any others or is it kind of across the board?
For us, it's across the board. Right now, we have a pretty robust portfolio of ESOPs that we're doing. We have 2 ESOP transactions going on right now. One is a software company, and the other one is a transportation and logistics company. I have actually a number of transportation and logistics companies in my portfolio of ESOPs. I do have some construction companies, a number of service companies. Engineering service companies, architects, it's really across the board, because I do believe that, if the business is sound and you have good leadership in place, regardless of the industry, you'll likely make a good candidate for an ESOP. But, for us, it's such a variety across the board. I understand that, with COVID now, there's some industries that we're not going to see ESOPs, and we're probably not going to see a lot of transactions in hospitality, as you know. There are certain industries right now that are down. However, when things start to rebound, you actually might see a little bit more in terms of ESOP transitions, because of the tax advantages and of the ability to maximize cash flow. So it might be, coming up in the next 24 to 36 months, where we're going to see even more ESOPs, because of just the structure and the tax advantages of how, these transactions work.
Well, and I think it's also the employees. If you have an employee base that's really wanting to take over control of the company, you can't just have people that are like, okay, maybe that sounds like a good idea. I mean, you really have to have some alternate leaders to make it really sing, and the cash flow. But another, I think, situation is that, so let's say the business owner decides that this is the best idea. This is the plan that I want to go about. What types of advisors do they first get involved in this ESOP transaction? And then what role do you take on?
Yeah, great question. Owners at times are a little bit surprised when, they realize just how many advisors it will take to accomplish or effectuate the transaction. So when it comes to the business owner and the company, we always recommend that they hire an advisor that's not, their normal CPA or accountant, to conduct, a feasibility study. There are companies out there that perform these feasibility studies. They actually go in and work on behalf of the exiting shareholder and the company to determine whether or not an ESOP is even feasible before you move to try to effectuate a transaction. So I would suggest right then is say to any business owner that calls me and say, I'm thinking about an ESOP. Can you value the business? And I said, well, regulations are a little bit different now because it's heavily regulated by the Department of Labor, the IRS. There's guidance under ERISA that needs to be observed. So, I typically refer my business owners that call, get a feasibility study. There are a number of companies that take care of that for you. And then they essentially act as the advisor of the exiting shareholder in the company. So they work on establishing, one, is it feasible? And then, what's the price that we're willing to, or, what's the price that we're thinking that the business is worth? And we talk about in terms of ESOPs, the game changer for some business owners is that price, because we're required to pay no more than fair market value for the exiting shareholder stock. And very different from selling your business or your stock to a competitor or a third-party investment or synergistic buyer, where you're going to receive a premium above and beyond what a financial buyer would pay. So that's often a game changer, because if the business owner is seeking the highest price that they can get, an ESOP is not for them. Clearly we're held to determining what the fair market value is. So once the business owner understands that, signs on for that, and understands, I'm going to get fair market value, but there's so many other benefits to this, tax benefits both to the exiting shareholder as well as the company. So once that's done, then what happens is there is typically a trustee that is engaged by the employee stock ownership plan that acts as a fiduciary on the part of the ESOP, not representing the company or the exiting shareholder, but in fact there as the fiduciary for the plan itself. Now that fiduciary, that trustee, and typically we're going through a transaction, I tell my clients all the time, hire an outside independent trustee. Even if it's only for the transaction, make sure that you're hiring that independent trustee. Why? Because, if you're sitting on both sides of the transaction and negotiating with yourself, that's probably not a good situation. So you bring on an independent trustee. Often that trustee has their own counsel that helps them in terms of, the ESOP plan itself, and, just ensuring that the fiduciary, the trustee, is covered. And then that's also as part of the trustee teams when somebody like me comes in. I come in as the independent financial advisor to the trustee. And I establish on my side the fair market value of the business, or the interest in the business that's being sold. And then at that point, there are actually negotiations between the exiting shareholder and then the trustee. And oftentimes there are a couple turns of that, but always staying within the realm of fair market value. I mean, when you think about fair market value, it's always based on a hypothetical willing buyer, willing seller, based on, all having reasonable knowledge of the relevant facts. This is a situation where it's a negotiation between, two sellers that have, or two sellers, one buyer, one seller, that has reasonable knowledge of all the relevant facts. So that's exactly what the governing bodies of ESOPs, want to see. So there are, the initial transaction is, you're fronting a lot of costs associated with that to do it right. But then in a situation for a smaller ESOP, once the ESOP is installed and functioning, you could bring the trustees inside. You could have a group of trustees comprised of somebody in management, someone that is just in the, the general population of the employees to be represented, and, guide the ESOP by committee.
Well, and I think that you bring up an interesting point because, and you talked about an ESOP trustee. So the interesting thing that I think, if I try to break it down, because it is a complex situation to do this, is that as a business owner, you just can't decide, like you said, my business is worth $2 million. I'm going to sell my business for $2 million to my employees, and employees, you're just going to take it. That's not how it works. You're really, as the business owner, I liked how you said this is really a retirement situation. So you are, instead of selling your company outright, you're basically allowing the employees to purchase it from you.
Correct.
But in that instance, they have to have somebody on their side, right? Mm-hmm. And so in essence, in some capacity, when we ask, like, what is an ESOP trustee? That trustee is there to protect the employees through this negotiation of the purchase price in some aspect. But then you're saying that that trustee could be different for the transaction as it is for the ongoing trustee. Let's talk a little bit more about that. I know enough about ESOPs, but I think this is a good nuance that you get somebody different for the transaction that you do for ongoing. How does that work?
Yeah. Well, essentially, you definitely should have an outside independent trustee for a transaction. So in the case, we've had clients that sell that initial 30, their corporations, they sell that initial 30%, and then they sell in successive tranches until the ESOP owns 100% of the company. And, for each transaction, they brought in an outside independent trustee to preside over the transaction to ensure that the ESOP, and in particular the ESOP participants, the employees, are getting a good deal, and ensuring that that deal transpires under the guise of fair market value. Now, we have a lot of clients. My largest client has 1,100 employees, 1,100 participants, and this company is extremely successful. They have paid off their debt years ago. They're an S corporation, and all of that cash flow stays in the company for growth, for repurchase obligation, and when the employees see just how tremendous their efforts are in terms of translating to value, it's really a neat thing to see how the company value grows beyond, the exiting shareholder departing from the company. But in my larger ESOPs, those trustees independently stay on. So the people that are working internal to the company can stay and definitely work on, the business itself rather than, having to be encumbered with the trustee, responsibilities. But I have a ton of ESOPs that, they have internal ESOP committees that after the trustee or after the transaction is done, the trustee committee then presides over all of the fiduciary aspects of the ESOP. They're making sure that, the ESOP is functioning, that the annual valuation is done in compliance with, the fair market value standard, and presiding over transactions. So you can have it both ways, depending on, what the tolerance is for the people inside of the company, understanding that, yeah, you are a fiduciary. You can pay, you can buy insurance for that, but, you need to take that, your role as a fiduciary very, very seriously. And, typically, all of the ESOP trustees that I work with, both internally and externally, the independent trustees do such a great job in preserving and really looking out for the employees.
Yeah, and that's when we talk about the fiduciary responsibility, I think that becomes very important. But as we were talking, I think that an interesting piece is, let's say so as a business owner, I'm going to contact somebody to do a valuation on my company, right? And then what happens, and I've had this happen to me, is that, okay, thanks, Melissa, you did the valuation. Now I'm going to do an ESOP. And it wasn't a feasibility study, but let's say somebody did a feasibility study and they did the valuation. Can they just convert it to what so I think business owners have to understand that there's still the fiduciary is going to get a valuation for the employee side, right? To make sure that the business owner's price is correct or reasonable. And that's where you're really coming in the fiduciary side, basically, because you're doing valuations every year for the ESOP going forward. And that really is very different than just doing a valuation for normal purposes, right? But maybe there's also other elements that have to exist to be successful in this process. Maybe we can talk about some of those.
Sure.
Or kind of how, I've thrown a couple different things on you, but realistically, there's two different people. You can't work for both sides, essentially. Okay. Correct. So the business owner might reach out to somebody, and let's say they reach out to me and say, okay, great, you did a valuation. Now can we just use that for the ESOP? Is that possible?
Well, if you've done a valuation for the company in the past, or you're doing it on behalf of the company with respect to the transaction, no. What happens is the trustee is going to engage someone like you in another firm. Before, there have been a lot of, and I know we'll talk a little bit about that, but there have been a lot of, challenges to ESOPs in the courts, and the validity of ESOPs and that fair market value. And one of the things years ago when I first started doing ESOPs is I would do feasibility and then I'd go on and do the valuation. And that's now, for the ESOP, that's now a no-no. You want to make sure that, I don't have any prior experience or assignments with the sponsor company. I come in very independently and separate and apart from the company, no prior relationship, and do that valuation solely for the trustee. It's not in the best interest of the ESOP and the participants for me or my firm to have a prior relationship with the company. We want to make sure that, both in fact and appearance, that we're that we're independent and working for that trustee. So, you, Melissa, could stay on the part of your client with whom you've done some valuation work for in the past and establish that fair market value, but they need to understand that then, someone like me is going to come over and perform a valuation for the trustee. One of the things that I should mention that is always come to a surprise to the business owner is, the company, is going to be footing the bill for all of this, and the trustee actually maintains and retains my valuation report. That valuation report does not go to the company. All the work you do can certainly stay with the company, but business owners and management well, can I see your valuation in connection with the transaction? I said, well, no, I was engaged by the trustee. The trustee actually owns that valuation. So that's always something that is a little shocking to business owners. They say, what? I can't have access to that, but that's a little bit of a nuance in terms of how these transactions occur now.
But that's protection, because I think one additional layer, which I think we can talk about a little bit now, one additional layer that if you're doing ESOP valuations specifically for the participants, for the ESOP owners, the employees, that you have a government entity that is looking over your shoulder to make sure that business owners are basically not screwing over their employees. And Department of Labor, right? DOL,
yes.
is kind of watching over this. So talk a little bit about this, because I think also ESOP valuations tend to be more expensive than regular valuations, but it's because of this layer of complexity, one, and two, it's partly because of DOL. So talk about some of the things that you have to be mindful of if you're actually doing ESOP valuations.
Yeah. But to your point, the reason, Melissa, that they're more expensive, and just to digress a little bit,
Sure.
is because not only are we doing a valuation for the trustee, we're actually doing a fairness opinion to let the trustee know that from a financial point of view, we feel, or our opinion is that it's fair from a financial point of view. So on top of the valuation that we're doing the fairness opinion. We also do a transaction analysis. Even though you would come in and do the valuation, potentially look at the future cash flow of the business and say, well, I think an ESOP is feasible. Just because you and the business owner think that, the trustee has to have confidence that it's feasible as well. So, I, on top of that, perform a transaction analysis to look at, okay, we're acquiring debt. The debt is going to need to be paid off. Here's the expected future cash flow. How does all of this come together and behave? So that's why it gets a little bit more pricey in the initial year. All of those things need to happen, but after that, business owners are very happy to know that, the cost for the annual valuation is what, it's less than half of what they paid, initially. So, to your point, there's a lot of due diligence that needs to occur. The Department of Labor is out there and regulating the stuff. There have been cases that have been out there challenging companies and business owners that were exiting the company, mainly at the price that they're transacting at. They're always looking for that fair market value standard. And there have been situations. There was a case that got on everybody's radar screen a number of years ago called Great Bank versus Perez versus Great Bank. Perez was the former Secretary of the Department of Labor. And basically, what had happened is, the company paid, the ESOP paid more than fair market value, or what was determined to be fair market value for the shares in the exiting shareholder. So, it's always important to, ensure that the business owner understands that this is fair. It's a financial price. It's going to be what a financial buyer would pay for the business, not what one of your competitors. It's going to combine assets and operations with you to provide more of a premium and give you, one or two more turns of EBITDA. That's not what can happen. So there has been controversy, based on some of these transactions that are believed to have occurred at more than fair market value. But outside of that, there is a document, an ESOP plan document that governs how the ESOP will conduct its its dealings with the company and the participants. And, the fiduciaries or the trustees are there to ensure that plan document is being respected and observed. So, there are a number of things that, if they're not properly respected, and understand that, there could be a situation where, somebody didn't get allocated the right amount of shares and, it's corrected, those things are, harmless. It's situations where, intentional harm is being brought upon the employees through the ESOP and not observing that, this is as you said, Melissa, it's a qualified retirement plan.
Yeah. Well, and are all people, and I don't know if you know this, but are most of the people that are doing ESOP valuations, are they always issuing fairness opinions or are just certain companies? Because I think I've seen in the past where some people have done ESOP valuations, but they maybe don't always issue the fairness opinion. Is this normal or should they always come together?
Well, regardless of who does it, and I do know of, some of our competitors out there that only want to do the valuation, and it's policy of their firm that they're prohibited to do the fairness opinion as well. And you can see some of the logic behind that, but in the transaction and doing the proper due diligence, the trustee is going to want someone to prepare that fairness opinion. Makes it a lot easier when it's the same firm who understands the transaction, prepared the valuation, has reviewed all the documents, has been very intimate with the process. But you're right in that there are some firms that do not want to do both.
Yeah, because it's basically we're vouching. If you're going to issue a report or you're going to do the valuation, the fairness opinion is that you're vouching for that report, that this is a fair price. And traditionally, the trustee needs that and wants that because you're taking on the responsibility of saying that this was done right. And with that, that's part of also why these tend to have a little bit more cost on them, is because I'm never issuing a fairness opinion on a valuation ever, right? And that is, and sometimes I think the reason why people aren't issuing fairness opinions is because they don't have the capability to. So it's a little different because you have a background that's valuation and accounting, right? And so you're able to do some of those things. But I figured that not everybody is doing them. So I think, would that be a recommendation that if somebody's looking for this type of work, to have both of those capabilities at one place?
I would think, yeah. I mean, I think that'll help you get the work. Trustees interview. I mean, there are certain processes that the DOL actually wants to see the trustee go through, even to engage a valuator, a financial expert on their side. So anytime I work for a new trustee, there's actually an interview process. There's a qualification process. I complete a questionnaire, and then oftentimes there is an interview involved. The trustee wants to ensure that you're doing quality work, you have experience in doing ESOPs, because it's such a different area of practice, and you need to understand the nuances involved. When we do a valuation of a company that's not an ESOP, do we ever have to understand what a repurchase obligation is? No. Do we have to understand or be concerned with if we're going to redeem or recycle shares associated with the ESOP? No. It's it's a different animal, and trustees are really doing a great job in properly vetting through their team that's working with them to ensure that the proper due diligence is performed.
So let's say if we go back to kind of our path. So we have a business owner that has now decided to do this. Maybe they've hired their own expert. Maybe then they've hired a they got the trustee, they got you guys on board to do the valuation for the employees, and they're going down this path. So now they have to come up with kind of what type of information that they're going to actually give to the ESOP participants or the employees, right? And so let's talk a little bit about what's next, the ESOP plan and all of these good pieces.
Yeah, that's a question we get quite often from owners and management of businesses. They want to understand, if we become an ESOP, do I have to show the employees our financials, compensation, what we're spending on capital investment annually? They're very concerned with the amount of information that they need to share annually with the ESOP participants. And, there's no requirement to share those that type of information. You're required to obviously share the plan document. Employees are going to receive a statement of their account every year. So, typically is an exciting time where they can see, what their account is being allocated, how their account has grown. That really incentivizes the employees. But in terms of, getting detailed financial information, that's not, required, and employees aren't entitled to see that. There are certain situations where employees can or will be involved, are invited to voice opinion if the company is going to sell, merge, things like that. But employees aren't going to be involved in day-to-day management operations of the company. They're there to be rewarded for the great job that they've been doing prior to the ESOP and that they're going to continue to do. For me, ESOPs are probably one of my favorite areas that I practice in. Seeing those recurring clients every year, seeing how from the initial transaction, how they have grown, how employee accounts are growing, how employees take some more pride in what they do. Not saying that they weren't before, but employees, once that they understand that you are being given without having to pay for it, shares of this company, the transformation that you can see is pretty neat. So it's definitely probably my most rewarding area of practice.
Well, and I mean, the psychology is there. The more you have ownership in the entity that you are working for, the harder you'll work.
Yes.
Like the more you're invested in that particular outcome. I think another question that I can think of is, what do you normally see? So the business owner comes in and says, I want to do an ESOP. Are they trying to transfer 100% of the company? Is that person trying to stay in control of the company? Like, do you normally see vesting periods of a certain time frame? Or is it just different depending upon every company?
Yeah, I think it's very different. It really depends on where the business owner is. If the business owner is a little bit younger and they see this as a transition, they might only sell 30% of the business and kind of get comfortable with employee ownership and then sell in tranches. And that's actually a good way to make an ESOP affordable for a company, is to do that and take out financing in tranches. So we're not having to expend so much with the debt where everything's going to be slim until we pay off the ESOP debt. Really doesn't make that too feasible. But another great thing about ESOPs is that it's very different than when you sell your business to a third party. You might want to, you might stay on for a little bit to transition the business, and then so long. ESOPs, it gives you a great opportunity to stay on and really transfer the business over to the employees and the future of the business. And that's why we make sure that the current owners understand that, is that if you're a control freak right now, you really don't make a great candidate for ESOPs. You really have to have that environment for employee ownership.
Well, let's say that somebody says, okay, I want to have like a 5-year plan. So I want to sell 20% every year or every other year, maybe it's a 10-year plan. Is that one of the reasons to have a valuation every year, or is it a requirement to do a valuation every year after you've done the ESOP?
Great question. As soon as you institute or install an ESOP, you're required by the Department of Labor to value it at least annually.
Okay.
And you're managing, for us, we work with management of the business in understanding and managing that value year over year. Making sure that, we're always in adherence with fair market value, but, always making sure that there's some consistency from year to year. But yes, it is a requirement. Some of my larger ESOPs actually need to be valued quarterly. And, that's for employees that, they have a high volume of employees that are placing their shares back to the company for whatever reason. They're going to do that, that valuation, maybe twice a year, even quarterly. It really just depends. And that segues into a great question that I've been getting from a lot of my ESOP trustees, which is, hey, I'm supposed to value this annually, and COVID has really done a number on my business. Should we value it now for, employees that are placing their shares of the company now, and I have to revert back to a value as of 12/31/19 when COVID wasn't known or knowable. And that's something we're dealing with on a case-by-case basis, because you need to really stop and look at, okay, what's the volume that you expect of transactions? Would it make sense to spend the money to do a mid-year valuation? Because yes, of course, there's uncertainty, and for some industries, that's going to have a dramatic impact on value. But if you have a situation where, we don't have a ton of employees vested yet, so we just want to make sure that, if something were to happen, it's not valued at that year-end price when it wasn't known or knowable. But the trustees really lean on us to advise them as to, does this make sense? And we might need to get the plan administrator involved to understand, okay, what does this look like in terms of, volume of employees that may be placing their shares and, dollar-wise. But yeah, at least annually.
And part of that is because, we use a lot of terms that maybe people don't understand, but part of that is what you're talking about is that if an employee has some stock ownership in that company and they decide to leave or retire, they're going to then put back to the company and say, you have to buy my shares back. And so it's kind of like them cashing in on their retirement in some capacity. And that is based on the last valuation, if they're only doing it annually.
Correct.
So now we have a lot of companies that are probably coming to you and saying, should we do it now? Should we do it every quarter? What's happening? And it poses a little bit, because right now we're dealing with valuation issues in general. Just to do a normal valuation. But if actually somebody's going to buy out, is it fair? And how do you get to fair, I think becomes a really big point during COVID.
Exactly.
Because you may have some employees that maybe didn't want to exit at this point, but because of health reasons or whatever, they have to do something in the midpoint. So in that situation, if the last valuation was as of 12/31, like let's say we're talking about it today, and I need to be bought out of the company, and the last valuation was 12/31/2019, is that the price that I would then be bought out at? Or you're saying that some people are considering doing valuations in the interim?
Yeah, some places are considering that. We've actually spoken to trustees about that, because you need to go back to the plan document to see if it allows for interim valuations like that. And some plans actually don't. But a lot of the plans that we're looking at now, they provide a certain kind of a caveat there that says that, if something has happened to the company, you can prepare an interim valuation. But I'll tell you that the trustees will consult with ERISA counsel, legal counsel, to determine, what is fair ultimately at the end to the employees. We chime in terms of, okay, this is cost benefit right now. The valuation would cost X to do, and the person leaving only has this much in their account. Do we really want to do that? And the ultimate decision is going to be happening at the trustee level with advice from legal counsel.
Mm-hmm. And it's hard to talk about valuations kind of in this interim point. I've been talking to some people, and I said in a couple years we're probably just going to ignore 2020. We're going to say hopefully this is just a one-time thing. The problem is we don't know. We don't know how long things are going to last. We don't know the impact. Some people in the short term have been very successful, and in the long term may have issues, and vice versa. And we've talked about a lot of things that I think are really beneficial to doing an ESOP, but there's also some challenges to ESOPs, and there's some scrutiny and controversy around ESOPs. And you talked a little bit about it with that one case. But the reality is there are way more cases regarding ESOPs, probably mostly from a business owner, maybe pricing it too high and it's not being fair for the employees. But what other challenges have you seen, and how has it sort of come in the courthouse kind of situation?
Well, most of the things that we see that go through the court are dealing with the valuations of the companies and ensuring that fair market value is being observed. There have been a number of cases, and each of these cases will establish some type of procedures or protocols that need to be observed by that particular institutional trustee in terms of their dealings with ESOPs. And we working a lot in this niche area, we're looking at all of the court cases that have come to pass, ensuring that we understand what the protocols were in those particular cases, and trying to make them best practices for us, in terms of preparing our evaluations. But always setting that the price at fair market value is being challenged. And there are a number of things that we need to make sure that we're checking the box and doing our due diligence. And the biggest area of challenge, I will tell you, is since value is always forward looking, we're typically getting forecasts from management. And one of the challenges that you have is and sometimes they're a little bit more goal focused than most likely. And we have part of our due diligence is we're really going in there and kicking the tires on these forecasts. And with initial transactions, that can be difficult because we know the recent history of the company, but if something has recently changed for the better, and the company is preparing a set of projections that have some super high growth, it's very difficult to accept them without having a little bit of angst as to can we achieve this. It's one thing for the business to start experiencing growth 3 years before installing an ESOP, and then you have that track record where you have some confidence. But the other thing I'll tell you is once an ESOP is up and running, what we do for our annual ESOP clients is every year we look at, okay, last year you said that in 2019 you were going to achieve $2 million of operating income. What actually happened? And we gauge year over year how accurate management is. How do they go through the process of putting together the forecasts? How do they vet through the assumptions? And then how do they actually how do they perform based on prior year forecasts? And then we do then establish a track record from which we can start having a lot of confidence or building confidence in the way management is forecasting. So I think that's one of the biggest challenges when it comes to ESOP valuation is ensuring that those forecasts are really the most likely and not really goal or sales oriented forecast. The other thing that I think is just a huge challenge for ESOPs is really observing and respecting that repurchase obligation. As you talked about, there are certain triggering events. There's retirement, death, disability, as well as diversification that's allowed for that causes this repurchase obligation. And you don't want to have to deal with it the year that, so-and-so is up for, diversification of their stock. They can diversify up to 25% of their ESOP holdings. And, that could create an immediate issue. You want to plan for those things ahead of time. We always encourage our clients to get a repurchase obligation study. There are a number of places throughout the country that specialize in doing those types of projects that the company can engage to understand. Okay, down the line, we have these obligations, but brought back to present value, this is what we're looking like now. And that helps tremendously, because if you get to a point where the company can't afford those repurchase obligations, if it becomes too unwieldy, that creates a big problem.
Well, and I think a central thing that people don't necessarily always understand is that when we're doing valuations for estate planning, we are doing them to defend that valuation against the IRS, right?
Correct.
When you're doing ESOP valuations, you are doing it to defend that valuation against the Department of Labor. And that becomes very important, because it becomes important for experience. You have to have experience ever defending a report, experience and knowledge about how to do it correctly. These aren't fly-by-night areas to be involved in, because what you don't know could really hurt you in these types of situations, especially if you're setting this up and you got one chance at the beginning to kind of set it up correctly. So I think that it's really important to work with people that have a depth of knowledge in this space. I have always said that I don't have the depth of knowledge, but let's talk more about you and your history and your company, because the reality is, if somebody goes down this path, there are not a large number of reputable firms around the country, much less in any one area. So a lot of times people are going to firms that may not be in their location, but they are reputable firms, because you're not just going to find a firm that's in your little town or even possibly in your state. So maybe if you tell us more about you and your background and your firm, it reasonably could be that if you're in Missouri but you need this, talking to somebody in Pennsylvania about this isn't a far stretch, right? I mean, because you really want the best to be able to protect yourself in this type of strategic planning. So tell us more about Melissa.
Absolutely. Well, and just to your last statement about you can really go anywhere. I was just talking to ERISA counsel this morning for an opportunity in Arizona. I have ESOP companies throughout the country, so it's possible. And I do. We're a smaller community, I think, of the people that do ESOP valuations quite regularly. But there are a lot of quality firms out there that do what we do, and we often cross paths. But so I work for Grossman, Yannick & Ford. We're a regional certified public accounting firm. So in addition to the consulting group that I run, we have a full service audit and accounting group. We have a full service tax compliance group. We have an ERP group, which is basically technology services for accounting software. So we're a pretty diverse firm. We all work in our specialty groups. There are about 70 of us, located, as you said, in downtown Pittsburgh, Three Rivers. My office actually behind me, it's the convergence of two of the rivers, and I can oversee Heinz Field. But I've been doing valuation work for 20 years now. I've been a partner for a decade in our valuation group. Our practice is actually split evenly between valuation work, very much like what you do, Melissa, and then the other half of my practice is litigation support. And my colleague and I always say that we think that part of our practice really lends itself to being a little bit better of a valuation professional in the realm of ESOPs. We've seen the other side of things, when there are issues. We understand, the necessity of proper due diligence, and I think that gives us a little bit of that incentive, having to see, when deals go bad, and things have to unwind. Let's do this right the first time. But so that's me and my practice. You can find me on the web.
Well, and we're going to post every way that they can reach you. And the other thing is, I think that you're exactly right. When you have to go to court and defend your value, I think you're always looking, and you're sort of a neutral, right? You're always looking at, is this fair? Am I too high? Am I too low? Is this a reasonable assumption? And you're always thinking about defending it. But also, I know if you and I talked about it, we do a tremendous amount of valuations every month. And so this isn't something, I think you really have to seek out people, because some people might say, okay, well, I want to do an ESOP and I have a good accounting firm, like they should be able to handle it. But I'm just trying to tell people, it's not really that we're just, talking about this as a hypothetical. It really is. Whenever I've been involved with an ESOP, we've always looked at around the country, who are the top 5 to 10 players. And then they go through a process of kind of vetting them and interviewing, like you said. Maybe there's a bidding process to see for the pricing for all of the pieces.
Sure.
And then there's a decision. So it's not like, oh, I like Melissa, I'll just have her do it. It really is a little bit bigger process. But everything that phone numbers and emails and all of that good stuff to contact you. And we've known each other for several years, so I know she does good work. But really, if you're going down the ESOP path, you need to find a professional that specializes in it. And that's coming from another valuation person that is saying that, because I don't specialize in it. And I think that there are a lot of areas that you could trip up in if you don't know what you're doing. So thank you so much, Melissa. I appreciate it. And I think we are good for this podcast.
Thank you.
All right. Talk to you soon.
Great.